Today is Sunday, 4th of February 2018. S&P 500 recap. So my call for Friday was lower prices to print, which we had. Ended up being a pretty bad day. Selling just accelerated throughout the day, and we ended up near the low of the day as far as the candle is concerned. I noted previously that the concerning thing was we had this gap, which originally I noted as an exhaustion gap, which I need to correct myself and apologize, because first of all, I don't want to give out misleading technical information and confuse people. This was not an exhaustion gap. In fact, it was a runaway gap. Now, why this I'm calling as a runaway gap and not exhaustion gap? Because exhaustion gaps will always occur in the final moments of an up or a downtrend. So for example, here we could possibly call this an exhaustion gap, but I wouldn't, because the move from it was still quite considerably higher from that point. But nevertheless, runaway gaps are established after we've had a major move and a sell-off occur. Now, if we establish and we know this is a runaway gap, for those who understand how runaway gaps work, and what follows is we get a succession of at least two more gaps. So on Friday we had another gap here. So after runaway gap, the second gap we note as a breakaway gap. And usually once we get a breakaway gap, the probability of another gap forming, possibly come Monday's trade, becomes higher. So once it's established, we have one breakaway gap from the one runaway gap. More times than not, we get a third gap, which completes the series. So my call is for Monday, given the sell-off volatility on Friday's candle, there's a high probability that I believe we're going to possibly open lower on Monday. The obvious target would be to fill this gap. I mean, there's one of many gaps along here, but the obvious one would be the first target, this gap at 27.13. Now, what I like to do is I like to start to measure these moves in percentage terms. So if we go to the body of this candle from the top, in percentage terms we have 5.56%. Now, why is this important? Because I know institutions, when we get a market in a correction phase, and if this is the early stages of a correction, instead of trying to guess and call where the bottom might be, we can measure it in percentage terms. And why I believe this area could be important and we could possibly get a bounce from there, institutions like to set buy orders in percentage terms here. Whether it's the end of the correction, we have to wait and see. We could possibly get, if it does hit that, a corrective bounce. But depending on what happens on excuse me, in the bond market, if the 10-year yield continues to rise and bonds continue to sell off, that could just be a minor bouncer corrective wave. Then we could possibly see another leg down. Given the strength of the S&P 500 over the past year and where it is in the overall cycle of this bull market, I wouldn't rule out eventually further prices to print. As I said, there could be support around this 5%, around 27.13 area. So that's an area to mark and possibly go long if it holds. I think that may be short-lived, and we could possibly see another leg down. Just another note with a runaway gap. Once a runaway gap is established, as we have here, like with breakaway gaps, these gaps don't get filled for a long time. So if this is the case, this could very well be the top of this market cycle, and eventually we have lower prices to print. Now, for those of you that want to understand more about the morphology of gaps and how they work, I'll put a link in the description to this video. So anyway, my call is for the S&P 500 is Monday. We'll see continued selling pressure, but I think come probably Tuesday or Wednesday, which times out to a cycle low point, we'll see a rally later on midweek onwards through to Friday, and then we'll see what happens the following week. Just one more thing to note: if we switch across to the weekly chart, just delete those for a second. So this is last week's candle, a big wide range red body candle. As we can see in the past, this is one thing I taught my students, is when we get these big WRC candles, more times than not, the following candle in this example on the weekly is we get a following continuation of that candle. So in other words, we get further selling. So if we look here, which occurred on 17th of August 2015, the following week, just zoom in on that a bit more. The following week, the low of that candle if we measure that, copy that arrow, see that? See how the length of that candle equaled the length of the previous candle? And once again, it didn't really occur here, but we did have further selling. So my point is that this signals here that the probability of further selling is more than likely to come. So I wouldn't be trying to trade in the opposite direction on this. I wouldn't be trying to take long positions just yet. As I said, look for late Tuesday, possibly Wednesday as a turning point. And that area that I noted on the daily chart of the first target of 27.13 to backfill this gap could be a possible area where we see buying support come in. And that's my call for the S&P 500.